Hey everyone! Welcome back to our channel. If you're new here, don't forget to hit that subscribe button so you can join our journey of learning all things finance. Today, we're diving into a topic that often confuses both beginner and seasoned investors alike, the difference between ETFs and mutual funds. So, grab a cup of coffee, get comfy, and let's unpack this together. Now, you might be wondering, what exactly are ETFs and mutual funds, and how do they differ? Well, let's break it down. First off, let's clarify what we're talking about. Both ETFs, or exchange-traded funds, and mutual funds are investment vehicles that pool money from multiple investors to purchase a diversified portfolio of stocks, bonds, or other securities. But they operate quite differently in several key areas. One of the most significant differences lies in how they are traded. ETFs are traded on an exchange, similar to individual stocks. This means you can buy and sell shares of an ETF throughout the trading day at market prices, which can fluctuate based on supply and demand. For example, if you decide to invest in an ETF that tracks the S&P 500, you can buy or sell shares anytime the market is open. On the other hand, mutual funds are only traded once a day after the market closes. This means that when you place an order to buy or sell a mutual fund, it will execute at the fund's net asset value, or NAV, which is calculated at the end of the trading day. So if you place an order at noon, you won't know the price until the market closes. Next, let's talk about management. Most ETFs are passively managed, meaning they aim to replicate the performance of a specific index like the Nasdaq or the Dow Jones. This passive approach typically results in lower management fees compared to actively managed mutual funds, which try to outperform the market through research, stock picking, and market timing. For instance, an actively managed mutual fund might charge an expense ratio of around 1% to 2%, while an ETF tracking the S&P 500 might have an expense ratio as low as 0.03%. This difference in fees can significantly impact your returns over time. Another point to consider is the minimum investment requirement. Many mutual funds require a minimum investment, often around $1,000 or more, while ETFs can be bought for the price of a single share, which can be as low as $50 or less, depending on the fund. This makes ETFs more accessible for beginner investors or those who want to start small. Tax efficiency is another area where ETFs often have the upper hand. Due to their structure, ETFs tend to be more tax efficient than mutual funds. When mutual funds sell securities in their portfolio, they may generate capital gains, which are then passed on to shareholders and taxed. With ETFs, investors can buy and sell shares without triggering these capital gains, making them a more tax-friendly option. Lastly, let's discuss the types of strategies each fund employs. While you can find both ETFs and mutual funds that cover a variety of sectors, asset classes, and investment strategies, ETFs are becoming increasingly popular for niche markets and specific themes, such as sustainable investing or emerging markets. Mutual funds, on the other hand, often focus on more traditional investment strategies. For example, if you're a socially conscious investor, you might find an ETF that focuses exclusively on companies with strong environmental practices. On the flip side, a mutual fund might employ a more traditional approach by investing in a mix of large-cap stocks and bonds. So, to wrap it up, ETFs and mutual funds both offer unique benefits and drawbacks. ETFs provide flexibility with trading, lower fees, and tax efficiency, while mutual funds might offer more hands-on management and potentially greater returns in specific market conditions. Ultimately, your choice depends on your investment goals, risk tolerance, and how much time you want to dedicate to managing your investments. If you found this information helpful, please give us a thumbs up and share it with your friends. Also, comment below with any questions or topics you'd like us to cover next. Remember, investing is a journey, and we're here to help you every step of the way. Until next time, happy investing!